Well, we're back, and 5 minutes still is passing very quickly. We just finished, or we're just talking about the accounting equation and how assets equal liabilities plus owner's equity is that accounting equation, and that the accounting equation must always balance. Now, if you'll notice, the accounting equation only has 3 of the 5 classifications of accounts. We have assets, liabilities, and owner's equity taken care of. But what's happening to our revenue accounts and our expense accounts? Well, revenue and expenses are getting summarized, or basically you can think of it as consolidated, into the account called retained earnings. So every time we have a sale or every time we have something like wage expense, that's making the retained earnings balance go up and down, and it's keeping us in line with assets equal liabilities plus owner's equity. Last few things out of the main part of the chapter. We have return on assets. That formula is net income divided by our average total assets. And if I could give you some help on maybe how to do that formula, one, we have to think of where do we go to find the information for it, and two, how do we use the numbers? So where do we go to look for the information? Net income is an income statement account. So if I need to find that number, I go to the income statement and I look for the place where we get revenues minus all of our expenses, and we get that kind of bottom line number down there that says net income, and we pull it off and use that number. Average total assets. Assets are on the balance sheet, so you have to go to the balance sheet to find that number. And the average, when you're doing your calculations, if you have 2 years, something like December 31st, 2012 and December 31st, 2013, to get the average, you have to take the balance at 13, let's say it's 15, and we take the balance at the end of 12 and it's 10. You have to add those together. So you say 12 plus 15, or excuse me, 10 plus the 15, we get 25. And then to get the average, we divide it by 2. We get that 12.5 would be the average. You have to put that average number in your calculation for return on assets. Then there's an alternative way to calculate return on assets. That's where we take our sales the sales margin, our profit margin, call it profit margin formula, times our asset turnover formula, and then that can also create the return on asset amount. Return on equity. That's the other problem, and it has a calculation of net income divided by average stockholders' equity. Well, again, you have the same issue. 1, where to find the numbers. 2, how to calculate it. Net income, income statement account. So we're heading to the income statement. Excuse me, net income is not an account. It's just a created number as the difference between revenues minus expenses. So it's on the income statement, so we go look there on the income statement to find it. And then average stockholders' equity. Again, if we have the year ending 2012 and 2013, we have to add those amounts together and divide them by 2, and that gives us the number to put in for average stockholders' equity. Now, moving on to the appendix, kind of 3 things that stick out to me here. We have audit reports, and auditors review management's representations in the financial statements and issue an opinion. So the auditor issues an opinion about whether those financial statements are fairly presented in conformity with GAAP. Then we have the SEC, that's the Securities Exchange Commission, and public companies have to report their financial information to the SEC. And then the main presentation that the SEC gets is the 10-K, and that is the annual report or the annual financial statements. Finally, we have the PCAOB, and that's a regulating industry of auditors. Better end it up. Hope this is helpful.